Hey, how's it going, guys? Welcome to the Module 3 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 3 is all about market structures and patterns. There are 4 sub-modules in Module 3, which will cover another 4 very important topics on technical analysis. Also, in the Module 3, we will go through some of the most powerful trade setups that you can use in different market environments. I'm really excited about this entire module because as a beginner trader, what you're about to learn in this module can truly take your trading game to the next level. In this tutorial, we will start from the module 3.1 and talk about the market cycle and the 4 very important categories of technical trades. Alright, let's get started. Before we jump into the market cycle, we need to understand what are the 2 major groups of players in the market. One group is a retail player. These are the mom and pops of the market, usually with small capitals. The other group is the institutional players. They're the large financial institutions like banks, hedge funds, insurance companies, and even governments. So the question is, who are the ones that truly move the market? I'm sure some of you guys already know the answer. The institutional players are the ones that truly move the market. In fact, they don't just move the market, they are the market. Their entire capitals are so huge that it's so much more significant than all the retail players combined together. Any major buying or selling decisions they make can impact the market in a big way. Not only they have the largest capital, but also they have the best information and the smartest people that work for them to help them make trade decisions. That's why we also call them the smart money. As a retail trader, paying attention to where the smart money goes is one of the keys to understand the market in a high level. So how exactly the smart money moves in the market? Study shows, in general, the smart money moves in a repeatable cycle. It has 4 different stages. First, it starts from the stage 1. It's called the accumulation stage. Then followed by the stage 2, the mark-up stage. Then it will reach the stage 3, the distribution stage. And followed by the stage 4, the markdown stage. So this is the big picture of the 4 stages of the market cycle. Let's get into more details. So why do we need to study market cycle? First, it helps us to understand the big picture of the market by focusing on the psychological perspective of those 2 major market players as we mentioned earlier. Second, it helps us to stay ahead of the waves by studying the crowd psychology of the public. Third, it helps us to study how individuals just naturally tend to make mistakes that work in favor of the institutional players so that we can avoid those mistakes and be on the right side of the market force. Lastly, it can help us to learn the distinctions and the specific patterns of each stage from a technical perspective so that we can take a high-quality trades in each stage of the market. Let's take a look at stage 1, the accumulation stage. So this is the accumulation stage. It is normally a sideways range market in which large institutional players are buying carefully and skillfully without moving the price too much. In this stage, the retail players are normally unaware of what is going on, so they will not pay much attention to it. So basically, the market is off the radar and all of the public focus were under the accumulation stage by the institutional players. This stage usually ends when large institutional players suddenly heavily buy and push the market to form a major breakout. Then it's followed by the stage 2, mark-up stage. This stage is also known as the classic uptrend bull market. Both institutional and the retail players become aware of the price movement, and their buying activities create a heavy buying pressure, which pushes the price higher. Institutional players who established their position in the previous stage, which was the accumulation stage, will keep holding on their positions and ride the uptrend waves. They may even add more positions to attract more FOMO crowds from the public retail players. FOMO means fear of missing out. In general, this is the easiest stage to make money as a technical trader. Also, it's the best stage for the beginner traders to start learning how to trade. After the mark-up stage, we come to the distribution stage. This is the classic stage of the market top. The uptrend ends, and the market enters a ranging market where the institutional players start selling their positions quietly. It's kind of like the accumulation stage. The distribution stage is for the institutional players to start unloading their positions. In this stage, the retail FOMO crowds who still think the market will go higher continue jumping in to take all the sell orders from those institutional players. Remember, In a market, if someone wants to sell and someone has to take all the sell orders to buy those stocks or any sell orders, and then these are the FOMO crowds, the mom and pops, the retail money that's sucking all the sell orders from the institutional investors' money. When institutional players start selling their positions in a faster pace with heavier volumes, or even accumulating short positions, it will eventually break down the support level of the distribution stage and enter the next stage, which is the markdown stage. Markdown stage is also known as the classic downtrending bear market. Institutional players' large aggressive selling and shorting orders create a huge selling pressure in the market. The volatility can be much higher than the markup bull market stage. Most retail players see their positions turn into much bigger losses and start panic selling too. Typically, when retail players start panic selling their positions, it means the end of the markdown stage is close. When this happens, the institutional players start quietly taking retail traders' sell orders and accumulating their positions again. So the cycle will start over again. Alright, so these are the 4 stages of the market cycle. As I mentioned earlier, the easiest stage to make money and also the best stage for beginner traders to start learning how to trade is the stage 2, the markup stage or the uptrending stage. Since this course is primarily for beginners, let's take a deeper look into how these classic bull market stages work out. First, it always starts in a kind of unnoticed under the radar fashion with very little public attention. When public starts noticing this short rally with a lot of uncertainties in the market, they believe it will go back down. So now is a good time to short. Market has mixed opinions. Once the institutional players push the market and support the rally, those short sellers early on will cover their short positions by buying them back. And plus, those people waiting on the sideline will jump into the market and start buying. The buying pressure goes higher and higher. Mainstream media will start the typical bull calls all over the news. Market continues its rally in a big volume. Then, the institutional players start taking partial profits. Those FOMO crowds, the retail investors who missed the big wave in the previous wave, will start jumping in because they don't want to miss rally again. Smart money starts selling some of those positions to the late retail comers. And next, we see the mainstream media and the public are becoming extremely optimistic about the market. FOMO crowds keep jumping in even more and push the price even higher. Market rallies, but with a much smaller volume. Smart money keeps selling to the retail FOMO crowds. The market starts to showing the weakness, and it's the sign of the market top. So these are some of the psychological factors behind the price action in a bull market. Maybe some of you guys have already recognized this pattern, or at least it looks familiar to some of you guys before. That's right, this is actually a simple illustration of a very famous pattern, the Elliott waves. I will definitely do a special course exclusively on Elliott waves theory because it's one of the theories on technical analysis that influence my trading the most. Even though you don't trade Elliott waves, studying about it will give you a massive value on your technical analysis. Here is some additional information to help you understand the market cycle better. First, in an accumulation stage, there could be many false breakouts before the market truly enters a major uptrend. Paying close attention to the volume is the key. In the markup stage, there could be multiple small accumulation stages. The order of the market cycle may not always be accumulation, uptrend, distribution. Sometimes it could be accumulation, uptrend, accumulation, and go on. But eventually, it will reach the distribution stage. There is an old market wisdom saying, markets always go down much faster than they go up. The bear market goes down tends to be much sharper and much more vicious, where those up and down swings in the bull market are usually much more in order, with low volume and volatility. Next, although it may seem like trading an uptrend market and a downtrend market are the same, just the opposite direction, this is completely not true. In fact, most of the professional traders only master one of each, because they realize that a very different skill set plus personality set combination is required to trade each market environment. Alright, now let's take a look at the 4 categories of technical trades. Every single trade we make based on technical analysis can be put in one of the 4 main categories. Studying about the 4 market stages can lay a great foundation to understand the categorization and applying them to our trades. So what are these 4 categories? The first 2 categories are trend following and the trend termination. These 2 categories are based on trend trade. The other 2 categories are support resistance breaking and support resistance holding. These 2 categories are based on the support and resistance trade or the range trade. So One is on the trend trade, and the other one is on the range trade. Most professional traders find that they achieve the best results when they have two counterbalancing trade setups in their system. What does it mean? For example, if your specialization is to trade breakouts, then you better add how to trade failed breakouts into your trading toolbox too. It's often ignored by many traders because many new traders, they only focus on one strategy, but it's super important to learn the other way because mastering two counter sides of the trade setups can force yourself to ask one key question before each trade. What could possibly go wrong? In trading, we call it the confirmation biases. It means whenever you make a conscious decision, your subconscious will always look for additional information that supports the decision, no matter that decision is good or bad. As the old wisdom says, if the only tool you have is a hammer, then every problem you encounter will look like a nail. So learning about the other side of the trade is crucial. It doesn't mean you have to take both sides of the trades. It's more to help you to see the risk of the other side. Alright, let's get into more details on each trade categories. First, trend following. In trend following, traders find a market with a trend and then look for setups to enter trades in the direction of that trend. Trend following is most suitable for markup stage and the markdown stage. Basically, it's the stage 2 and the stage 4. It's the best type of trades for beginner traders. Trend following trade setups tend to be easily identified, easy to understand, execute, and manage risk. Perfect for new traders to start building their trading system with. In trend following, your risk-reward ratio is more important than your entry points and win rates. Taking profits too early or cutting loss too late are the two biggest enemies to all trend following systems. One classic trend following setup is the moving average crossover. We mentioned this earlier in the module 2.4. We'll have one entire module later on in the module 3.2, especially talk about trend following and the trading strategies around it. Trade category number 2, trend termination. In trend termination, traders find those overextended spots in the established trends and fading them or shorting them, we call it in the trading, for quick reversal pullback trades. They are also known as a counter trend trades. Most ideal setups can be found in the markup and the markdown stages. Trend termination trades can be seen as sexy to many traders because of its fast pace, quick rewards, and going against the crowd's superhero nature. But it requires an extremely high level of both technical skill and mental skill to execute. Precise entry point and cutting loss quickly are the most important keys in trend termination systems. It's definitely not suitable for beginner traders, but it's good to learn how it works. Next category is the support resistance holding. In this category, traders identify the clear support and resistance level in a well-defined ranging market and look for trade setups when the price hit the support level and take profits at the resistance level or the other way around. It's most suitable for any well-defined ranging markets. Normally they exist in the first stage, the accumulation stage, and the third stage, the distribution stages. Learning how to manage ranges is an important skill if you want to be in a more advanced level as a trader. Market only trends 20% of the time. The rest, they're all in ranges. Support resistance holding trades tend to have the poorest risk-reward ratio, but they're compensated with high probability win rate and low risk. One classic trade setups in this trade category is called failed breakout trades. The last category is a support resistant breaking trades. It's also known as the classic breakout trades. Traders identify clear support or resistance levels in the market structure and look for trade setups when the price breaks the support level and it goes up or break resistance level and it goes down. They are commonly located at the end of the accumulation and the distribution stages, leading to either a new trend or continue pushing the current trend further. Support resistance breaking trades or the breakout trades offer an outstanding risk-reward ratio and are often glorified by many other traders. However, there is one small problem with all these breakout trades because most breakouts fail. Understanding the volume with seamless execution in this kind of trades is the key to succeed in trading breakouts. Because at the breakout level, the market tends to have usually really high volatility and low liquidity. We will have an entire module, the module 3.3 later on, specifically discuss how professional traders trade breakouts. Alright, these are the 4 categories of all our technical trades. One thing to know that these 4 categories is just a framework, not a strict classification. These 4 categories of technical trades are designed to provide a comprehensive framework for beginner traders to understand the different trade setups and choose the ones that suit the most. It's not intended to be a strict binary-like classification system, but rather a dynamic framework that can help new traders and even experienced traders to understand the market behavior more efficiently. Some trades may fit into more than one category, especially when you use multiple time frames to analyze one single market. Most importantly, for new traders, when you continue learning about different trade setups in the future, try to ask 3 questions on each new setup. First, which category this trade setup may fall into? What causes this setup to work? And how can this trade setup possibly fail? As a beginner trader, every time when you try to learn a new trade setup, asking yourself these 3 questions is a great way to learn the mechanics behind a new trade setup. Alright, we almost come to the end of this tutorial. In this module, we went through one of the most important concepts in trading, the 4-stage market cycle, and the possible 4 types of trades around the cycle. Well, before we wrap up, I really want to share with you guys one quote from legendary investor John Templeton. The 4 most dangerous words on Wall Street are, "This time is different." There's nothing new on Wall Street because the players in the market are all human. Even machines and algorithms are designed by human rules and human brains, which are dominated by human nature. And we all know human nature never changes. Remember, market always repeat in cycles. Whatever happened today has happened before and it will happen again. Alright, this is the end of the module 3.1. I hope you guys enjoy it and learn something valuable. In the next tutorial, we will go through the module 3.2 and then review the secret of trend following, the one single trading style that created thousands of legendary traders around the world and a massive wealth for them. Alright, I will see you guys in the next video. Bye for now.